Well, hello everyone. This is Ken Winans and Stephanie Larson from Winans Investments, and we hope that you are enjoying the winter weather. Needless to say, in California, we have had some serious storms over the last couple of days. But at least the lights are on right now, so we're happy about that. We just wanted to give you, we hadn't sent out a video since before the holidays, and we just thought it'd be great to catch up with everybody and let you all know where we're at and what's going on. And I'll start off with just telling you that, obviously the very powerful rally that we literally saw from maybe mid-October to now, which made up a lot of lost ground very quickly. You can just see the power of the Fed. The old adage, don't fight the Fed, is so very true. When the Federal Reserve says we're not going to raise rates anymore, you can produce those kind of rallies in almost any asset group. Then, of course, the other thing I would bring up is that January was very, very strong. And as many of you know, I'm a very big believer that January sets the tone for the year. It's the one time of year when you get corporate earnings. Federal Reserve's made their announcements. This year, we're late on the presidential State of the Union address, but you have the Treasury Department's borrowing needs for the year. You get every central bank around the world, even though those that are not on our calendar, report what's going on. So it's a lot of information that hits at one time, and the market digests it. Steph, anything you want to add?
Yeah, I'd say the January effect is what it's called, and it's been positive. All of our indicators have been positive, which is why we have the portfolios as fully invested as we can. The rally has continued through January. We're waiting to see if it wants to cool off a little bit. It's kind of getting into a little bit of an oversold position, but I mean, so far so good. A good example is I had a client that needed some cash in his account, and I literally couldn't pick anything that I wanted to sell. So we're really happy with where we're positioned right now and what's going on. At least on the equity side, we're quite thrilled.
Yeah, I mean, we told everybody in our last video that, look, we were overly conservative last year. I think with good reason, with what happened with the banking system and certainly the news around the world. Admittedly, we were cautious and maybe too much so. But with that being said, we've basically the stocks that we're in right now, the equities that we're in, and I would argue the bonds that we're in right now, and the preferreds that we're in, they do well in this kind of an environment. We have found those stocks that, many of you look in your own portfolios, we rarely use products, but if you look and see, they're an odd assortment of names, and they're in every industry group. Retail, finance, services, you name it. And while I'm thinking about it, I did crank out 3 Forbes articles basically in a month. I would encourage you to go read them because they do deal with how do we pick stocks. It also is giving you some projections of our feelings about presidential election years. What history tells us about that from an investment standpoint.
And the quarterly commentary, I would say too, if you haven't read it, it really is, this does tell you everything that we're thinking, what we're seeing, what our forecast is, our expectations. It really does give a lot of information.
Absolutely. So a couple of things to think about. Now, number one, we're still in the midst of earnings season. We just want to give you a progress report that so far so good. Number two,
some huge winners.
Oh, massive winners.
We saw some stocks get creamed. We weren't in them, but we were definitely watching. So it's been if you made earnings, and like Netflix would be a good example. If you had really strong positive earnings, the next day the stock just took off double digits, right? And vice versa. If you had really poor earnings, double digits on the way down. Actually, I forget what it was we saw the other day. It was down 25%.
The optical company. I'm
Yeah.
spacing on the name, but and we were targeting it, but we didn't buy it. So that's the good news. We didn't step into it.
So, but the interesting part with the earnings is that they're on either side, positive or negative, huge movement. So, which is why when we say we're a little cautious sometimes about earnings seasons, because you could step into one that we were targeting, pattern looked amazing, and just annihilated overnight. So, sometimes clients will ask like, hey, I'm in a little bit too much cash. And it's like, I know, and I want to buy something for you, but literally a week or two before earnings, you just get nervous. And this is a perfect example why. So,
well, and just so you know, many of our competitors were actively, and when I was at the Schwab conference, it was very loud and clear, pushing foreign markets, pushing emerging markets. They were trying to get everybody to get money out of the United States. That has been a disaster. Ask anybody who stepped
Yeah.
into China, anybody who stepped into European countries, these ETFs, once you adjust them for, I mean, we live in dollars. We don't live in Mexican pesos or the euro. We live in dollars. And when you adjust them, they have been terrible investments.
I will say some of the largest companies that I track personally, we don't hold them. But ones I'm very familiar with from previous companies that I've worked for, they're just getting creamed. And I don't want to
Absolutely.
name them because I don't want to really pick on any particular company, but yeah, it's some of the international companies that you're like, oh, it's the equivalent of like Amazon over there, and it's just getting annihilated. So you have to be really careful about stepping into ADRs, for sure.
I was going to say, let's talk a bit about 2024. I mean, we know that 2022, 2023, I'm going to call it the great whipsaw of this century. I mean, it was a very strange time to be in our business. But looking forward, a couple of things, at least my observations. I think that there's a lot of over-optimism that inflation is going to end quickly. I don't necessarily agree with that for a couple of reasons. Number one, go back and study the 70s. You had the initial boom caused by the oil prices that took off then, but it was the lingering effects of inflation, and what I'm mainly talking about are on wages. I think you're going to hear a lot of talk this year, especially in the public sector. I'm talking about anybody who works, whether it's federal government, state government, local government, whatever, big pushes by their unions to raise wages. You're going to see that in companies as well. You're going to hear it around the world. It's not just the United States. So I think that inflation will not drop quickly. And it's another reason why I don't think rates are necessarily going to drop real fast either.
Well, I would say that inflation, I do agree with Ken. I do think inflation can linger for quite a while. It can definitely come up and go back down and come up and go back down. It is lower, considerably lower, for
much
sure.
lower, yeah.
What Ken's talking about is wage push inflation, which means that, as companies have to pay their employees more because of the cost of inflation, and employers are saying, hey, I need a COLA, or I need to keep up with this, then obviously they need to raise the cost of their goods, and it turns into a cycle, right? So that's just general economic theory. The Fed has pretty much said that they're not specifically settling on a date of when they're going to start cutting rates, but the expectation is they are going to do it. My thought would be, as we get closer to the election, cutting rates becomes a little bit more precarious because it can look like it has a political bias to it. So I believe, even though they haven't said they're going to do it by March, I think they're going to do it sooner rather than later. I also think that will be a huge rallying call for the market, just in general. It's something that people are clamoring to see, and it would be a very bullish thing sentiment-wise. Even if it's just sentiment alone, it'd be very bullish for investors. So I think January is a good barometer, very positive, and breadth of January was very wide. So it wasn't like last year where it was just the NASDAQ or a small section of the NASDAQ that just took off while the Dow kind of and the S&P was like middle of the road. This was really broad, which is really great. I still think there are bullish things on the horizon, meaning the Fed is going to cut some rates. Doesn't mean we won't have a summer swoon like normal. It doesn't mean that there can't be a macro event that could be a setback for the market. But in general, our outlook, my outlook, I won't speak for Ken, is actually generally pretty positive.
Yeah, I would say it's neutral positive. I would just say that it is predicated on the Fed not raising rates more, and that geopolitical issues around the world don't deteriorate more than there are, and that the companies, like I said, there are companies that we're in they're very well positioned for this kind of environment. They're ran by very strong management teams. They know, and then many of them did very well through COVID. They navigated everything well, and so I think that it is a stock pickers market from that standpoint. A couple other quick things. We don't want to stay real long because we're going to try to do videos every month now. Things have kind of calmed down. The Schwab TD mergers, as you know, is all finished. You will be getting 2 sets of 1099s, so just be aware of that. Sorry about that. It's out of our control. But this is the last year. And then going into 2024, everything will be fine. The other part I was going to mention, I'm getting out on a road trip. I'm going to be out through the Las Vegas, Southern California area through much of this month, in and out. But if you are interested in having a face-to-face meeting, please contact Amy. She'll let you know my availability, my schedules, and we'll, certainly do our best to. I'd love to see everybody if I could. It's very tough, but ever since COVID, it's been hard to see people. So we're trying now to get back out and do things like that.
I will be holding down the fort. Don't worry.
Yeah. Oh no, it's not a vacation. Believe me, it's a drive trip. So we have that going on. Some other things that I think are just worthwhile bringing up. Please don't be lulled into think this market's going to go straight up, like certainly with what happened last year. This is a much more normalized situation. We don't want that. None of us want to go back to these high volatile scenarios. It drives everybody crazy. What I think we can tell you is Winston Churchill said, this is not the beginning, this is not the end, it's the beginning of the end of the inflation cycle. So I think it's safe to say that we believe that. Many of you who are in bonds probably will be pleasantly surprised that the bond prices and the preferred stock prices, these are income investments, have largely rebounded wonderfully. It's a mixed picture though. Stephanie will tell you in a moment. We like seeing prices go up, but it also means that any future purchases, yields will be lower.
Yeah. I mean, so the bonds have come up. I'm not gonna lie. It's a lot harder to get the same kind of yield I was getting for the last really 2 years. It doesn't mean I'm not getting good paper. I bought some 7% paper today. So it's more of a challenge. It's not as widespread. You have to go out a little bit longer if you want to really get some more yield. But for us, it always comes down to the fundamentals of the company, whether we like it and what the coupon is, the stability of it. So we always try to have a strong mix and blend of our fixed income portfolios. I still like what I'm building for people. We do have a lot of new accounts, and I think I'm building a pretty nice portfolio for all of them. So it's just taking a lot more work than it would have if this was 6 months ago. But that's the Fed. The Fed giveth and the Fed taketh away. So as they are going to cut rates, this is what's going to happen. It doesn't mean that, again, we can't still build something nice. It's just harder.
Well, and I would just say that it's still much higher than any comparable kind of yield you'll find in a bond mutual fund or in municipal bonds or treasury bonds. We're still offering a much better choice for the amount of maturity that we're going out versus some of these other things. I would just say, I get asked quite a bit, what can go wrong? Well, the election years are always tricky. I will tell you that if you read my latest Forbes article on looking at the last 31 presidential administrations, there have been bull and bear markets under both parties. There's no monopoly on economics with either of them. But I would just caution everybody, I do think you're going to hear a lot of talk, especially at state and local government levels, that the increased borrowing cost, the cost of refinancing the massive debts that many states and counties and cities and school districts and everybody has, is going to be a real problem. And I still maintain that anybody who has large positions in municipal bonds, you're going to, the Latin phrase, caveat emptor, let the buyer beware, I really think holds true. I think you'll find a lot of volatility in that section of the bond market, moving money toward corporates. We all know what happened in treasuries. That's been all over the map. We've already talked about foreign investments. I wouldn't touch a foreign bond right now. I think you have to be extremely cautious with what's going on there. And also I would just bring up the dollar. The dollar has actually been surprisingly strong. And if you have the dollar suddenly dramatically weaken, that could also reignite inflation in this country. But the fact that the market has blown off an awful lot of bad news around the world is really very telling to tell everybody here that the market is an economic animal. It's not a political animal. It is not a social animal. It's economic, and economics are generally pretty good right now.
I would say also one of the things you would notice on the portfolio side that we've been doing to start the new year. Ken and I had an investment committee meeting probably the second week of the year, where we really agreed that the rally was so strong in the fourth quarter. You'll notice a lot of the stock charts kind of went from positive to really accelerated, and we wanted to make sure we took profits, not to mention locking in some of the profits, not selling the stock because we still like it, But lock in some profits and also normalize the position, because positions can easily go from, say, an average of 3% to more like 4, 5, 6, or 7 on a real good run. So we wanted to make sure that we kind of normalized everything. So we actually did a lot of rebalancing and trading in mid-January, around there. We might have to do it again. It's just kept going. So we want to make sure that we don't have any overexposures. And so we'll manage them that way.
Absolutely. No, we're going to be very disciplined this year. We're not going to be swayed by headlines. We're not going to be concerned, and we're going to follow our numbers, follow our gauges, and do what you folks pay us to do, which is make calculated decisions based on the information that's out there.
Yeah.
Well, we're going to say, it's already gone 15 minutes. It's funny how we talk and go on forever, or at least I talk too much.
It will be short, but then never short. So.
But I do hope that I see some of you on my trip here. I will also try to get out more often throughout the rest of the year, especially Northern California, some of the other areas that we're in. We've picked up a lot of clients, and people are still leaving California and going to other places. So a lot of our clients are in different locations now. So it may be a little bit more of a stretch than it used to be, but we really do want to see our clients, if possible.
And I'm always here. Call if you need anything.
Absolutely. Oh, and by the way, we do Zoom and Microsoft Teams and all this other stuff. So if you guys want to have a video conference, please do that. But listen, we wish you and your families well. We hope that you're hanging in there, and just try to batten down the hatches. It's still winter time, but hopefully we have a nice spring. So we wish you well. Take care.
Take care.